This is Martin from Brokerage, the channel for learning about trading and investing. Welcome to markets next week, the weekly stock market analysis show. We try to basically understand from the technical charts what exactly happened in the market during the previous week and then plan for a better trading week ahead. That's starting from tomorrow, Monday, March 18th, 2024. Let's get into the charts. Here is a weekly view. This is the same chart that we're seeing every week, and we can clearly see that the flag number 4 had broken out, and then it has fallen back to the same neckline from where the breakout had happened. This is the Nifty charts that I see. Banknifty charts, you can see that the breakout did not succeed, and the price has fallen back into the channel of the flag, the fourth flag that we're talking about. Right. And here we have the another weekly view. You clearly see that the flag breakout did not sustain more than 3 weeks, and it has fallen back to the top. Nifty, you can see multiple flag breakouts, and you can also see that it's well within the trend line channel from where the rounding pattern breakout started, right? And it's still above the middle of the parallel channel in the case of Nifty, and then still at the bottom of the channel, below the median of that parallel trend line channel. So daily another view, it shows that the correction has come in on Nifty and the breakout has failed on the Banknifty. Look at the candlesticks. The Nifty weekly candlestick is wide range bullish, wide range bearish, heavily bearish. It's in fact has engulfed the previous candle, and remember it fall from the all-time high levels. Wide range bearish, a deep correction has come in, sharp correction, not a deep one yet. And Banknifty, we have a wide range bearish candle there as well, and remember previous week we went as close as 500 points away from the all-time high for Banknifty, but it just broke down. And you can also see that on the weekly charts it's somewhere near to the support zone from where the breakout had happened. Previous 3 weeks breakout had happened. It just fallen to the same place. Same with Banknifty also, it has fallen to the same place. So when it falls to a zone of previous resistance, there is a chance that it could act as support and then consolidate or bounce up from here for a change in polarity concept that we already discussed earlier, previous weeks. Look at what happened in the previous 5 days. The daily candle has closed as a small body, like case of Nifty, and it's also an inside bar. That means the candle is well inside the previous candles, and therefore it indicates that there is consolidation in the short term that's happening. But the previous 5 days, if you see, except for the last 2 days where one day was a dead cat bounce and then another day was consolidation. If you look at excluding those 2 days, the 3 days, especially the Wednesday, it was very sharp fall. So it was a very sharp correction of probably 2.25% or something. Banknifty has extended to 3.25% or something from the top. But again, the Banknifty, it's a small body and it's a dodgy. It's indecisive. So all small bodies are indecisive. Banknifty is even more indecisive, and both are close negative on the daily charts. Right. So that is for the 5 days that the daily charts are showing. It was a correction week, absolutely. And Bollinger Bands has fallen below the 20 moving average median with the bearish bias now, and it's contracting clearly sideways move indicated on the daily charts on Nifty as well as Banknifty. The contraction is also visible on the Banknifty with the bearish bias below the 20 moving average, which is the median of the Bollinger Bands. So Bollinger Bands indicate sideways in the short term. Before we come to support resistance, let's just wrap it up here. So we had a sharp sell-off from the all-time high, and Nifty closed red, -2% plus. 3469 points gone last week, and a wide range bearish candlestick pattern is also formed. Remember, we had a rally of 34% with only 4.5% in this communist correction so far. Banknifty also fell sharply and closed red, where a correction of 8.5% for a 26% of rally has come in. Last week it closed negative for 2.4%, sharp cut, 1,236 points gone. Interestingly, both the charts of indices, Nifty and the Banknifty, still managed to close above the 20 weekly exponential moving average. So, yes, the wide range bearish candle on the Banknifty also is there, which indicates bearish candlestick patterns. But in the charts, if you see, it was a retracement clearly seen on almost all the days except for Thursday and Friday. But Thursday there was a little cat bounce attempt and then a consolidation inside performed on Friday. So daily charts, indices here as I said, and it's closed 0.5% more down, and then again 0.5% down on Banknifty as well. And 20 exponential moving average is lost for both indices. So indices same as in the daily charts, short-term charts, and sharp for wide range engulfing bearish, not engulfing on Banknifty, but definitely wide range bearish candlesticks patterns on the weekly charts. So bears have come in, and the recent price gains that it made has been wiped out in a matter of few days, and no matter the trend has fallen back to the sideways zone in both the indices, and just lost the 20 exponential moving average support. But interestingly, the weekly exponential moving average is still intact, and the higher low higher patterns on the daily charts is still intact, and it's at the support zone where the breakout happened. So it's probability for a change of variety bounce cannot be ruled out from here. So the question in front is this a consolidation before the next leg, or is it going to be a deeper correction? Could it turn out to be a deeper correction? Right, that's a question, $1 million question. And all the bands we have seen that it's indicating sideways. So let's move ahead and see the sub-resistance level. So the first immediate resistance would be to clear the 20 to 145. That's exponential moving average. Once that's cleared, obviously 20 to 500, 526 all-time high levels and big rounding number. But a big rounding number 20 to 500 and 526 all-time high. That would be resistance, and after that it can go as high as 20 to 800, 850. So that's the channel top. And downside, the first support would come in at 21,838, and that's the 50 exponential moving average support. And we would have 21,530 for the Fibonacci 23.6 extension level also that kept coming. And previous swing lows would get breached at 21,800, which is therefore very crucial. The price pattern of the higher high, higher low that is formed would get negated if the swing low is breached at 21,800. Next swing low would be at 21,500. So 21,500 can also come in as support. And if in case that also gets breached, it comes to 21,264, which is the 100 exponential moving average, where close by at 21,150. There is a gap support as well. Those are the support resistance for the next week. On the Nifty and Banknifty, if you see, the first resistance will be 23.6 retracement level, which will act as resistance now. That's coming about the 47,000. And before that, you have the 46,880, very close to the 47,000, where the exponential moving average of 20, and 46,600 has got the exponential moving average 50, which is not breached, which it was breached, but it closes above that last week. So the first resistance will be 20 exponential moving average at 46,880. And then 23.6, 47,000 big rounding number, and 47,200. All that resistances would come after that. And then the swing high at 48,160 nearby is the previous swing high, where the next resistance could come in. Before that, 48,000, the big rounding number resistance. So 47,000, 48,000, all these are resistances. Previous swing high is coming slightly above the 48,000, right? So, and then all-time high at 48,636. So that's resistance. Upside support. The first support would come in at 46,100, which is 100 exponential moving average, as well as 46,000 is a big rounding number. And also we have the Fibonacci 38% retracement level that is also coming at 46,400 nearby zones. And so if that gets breached, there is a chance that it can go to the 45,120. But 200 exponential moving average is there, and 50 exponential moving average support is also coming above the at the 45,500 nearby zones. Those are all the supports, right? So 200 exponential moving average. If that is breached, it will attempt to retest the previous swing lows at 44,400, that kind of levels. Before that, 45,000 rounding number, 45,000, all these rounding numbers could act as supports. So that's where the Banknifty is placed at, right? So let's look at the momentum and the trend indicators on the daily and the weekly charts of Nifty and the Banknifty. Left side we have the weekly charts, medium term charts. So you can clearly see that the Nifty is maintaining the bullishness, but Banknifty has met with resistance and then slipped in the sideways, and that's all it is. And it slipped in the sideways on both the indices on the short term. So short term it is sideways. Medium term Nifty is hanging on with bullishness. But ADX, the trend indicator, is actually bearish on both indices on the short term. Bearishness is increasing actually on the short term, but in the medium term, Nifty maintains that bullishness, but it's having falling strength, while Banknifty has crossed over to the bear zones of a DMI negative. So our trend and momentum has got in the bear zones. The trend has gone to mostly in the bear zones, while momentum has slipped sideways, not in the bear zone. So back to square one is what has happened. All the gains of momentum and trend has gone in previous week. What had happened previous to previous week, all gains wiped out. Moving ahead, India VIX, the volatility index, the fear and greed index. That's a flattish close, despite the fact that the market had fallen sharply. The call-off is what is that? Not a call-off, flattish, absolute flattish close of below the 1430.69 is what has happened, which is kind of deviating from what was expected. Like when the market falls, which should have risen up to the 16 or 15 levels when this fall happened, but it didn't happen. So probably that gives a hope that this fall maybe for a bounce up. Yeah, so now you can say that it's still low voltage, which it had risen up about 15, 16 and all that previous weeks, but now that was the fear of heights probably. But going ahead when the elections are approaching, there is a chance and probability that the VIX can spike up. But as of now, the VIX having not moved much up when the market had fallen, gives hope that the market can rise up next week. Open interest data for the futures on IPC, it's bearish, it's long unwinding on the Nifty, and it's a short build-up that is seen on the futures on the Banknifty. So that's bearishness in the futures high, and put call ratio, which indicates the bullish and bearishness of the options of interest, is showing that it's not bullish enough, neither is it bearish. 0.80 on Nifty PCR and 0.7 on PCR on Banknifty, not bullish enough, neither is that bearish, you can see. So this is for the weekly options open interest. That's for the March 21st expiry on Nifty and March 20th expiry on the Banknifty. So yeah, open interest is bearish. Means open interest is where the highest betting for the option writers are down the put side and the call side. And you can clearly see that a lot of resistance. The green is the resistance that's appearing on the charts, and then the levels, if you see with the highest put and call writing is seen for the next week, is 21,000 and 23,000. 21,000 is where the maximum put writing is seen on the Nifty, while such a wide range of 22,000 where the call writing is seen. So traders are expecting that the market could explode on either side. 21,000 is 1,000 points down from where it is right now, and 23,000 is another 1,000 points up. So wide range speculation by the option writers is seen in the options. Nifty weekly. Banknifty is also seeing similar 2,000 points, but relatively less speculation. 44,000 and 47,000 where the highest put and call writing is seen. The second highest put writing is at 44,000 and 48,000 in the case of Banknifty, and 22,000 and 20,500 where the highest put and call writing is seen. The second level. So yeah, wide range speculation is there. Big resistances is what is dominating overall the charts. If you see, yeah, bearish PCR is what you see overall. Put call ratio. Sectorial indices, if you watch, it was not it was not a good news out there. We can see across the different sectors that had fallen. We have been talking about the charts of all these indices, and we talked about the indices having heated up at all-time highs on auto, heated up on pharma, heated up on FMCG, which already had earlier itself made the start with the correction, heated on non-reality, and exactly that heat has melted down last week with deep cuts across the sectors that has happened, especially the auto, pharma, reality and FMCG. Look at how much reality has lost. 9.5% in a single week. Pharma 2.5%. Metal has fallen nearly 7% in a week. Absolutely. Only sector that closed green is 1% up. IT sector. So metal, auto, pharma, FMCG, reality, all of them taking a beating, and none of these stocks are having bullish momentum on both the time frames, and therefore we had a weak before taking long positions there. Neither it allows us to take bearish positions because none of them are bearish either on both the time frames, right? So that's exactly what you can see there. Right? Clearly the IT sector seems to be making a cup and handle pattern. Handle can get formed and then it could again bounce up at some support zones. That's a right pattern, but why? But bullishness is maintained in trend and momentum in the case of IT, and metal also bullishness is probably just slipping down because of the sharp fall of 7% last week. It still has not fallen down towards the bottom of the channel. It still not breached the inward head and shoulder pattern on the medium term, but momentum slightly slipped sideways. Auto index sharp fall, but still maintains that bullishness on the medium term. The trend also has not crossed over yet. Pharma still maintains the bullish zone. Trend has not crossed over, but the heated up pharma had made a sharp cut last week. FMCG had started the correction several weeks, at least 10 weeks before it had started the correction after hitting the top of the channel, and it had earlier itself fallen into sideways and it was consolidating. So always when the price is heated up, if there is small corrections that are coming, that is healthy. But if it shoots up and go for vertical rocket moves without any correction, then the cuts that comes in may be this kind of cuts that is of nature of 10%, 7%, all that, which would be too much. And the sectoral indices, I believe, also reflects the probably the small cap and the mid cap as well. A lot of stocks maybe of that. And then following the SEBI directive, there was a correction that happened because of money being pulled out and redistributed to the large caps from the small caps and mid caps. Because of that, deep correction had come in there, sharp 20% kind of correction has come in there. That may be reflected in some of these indices as well. It's reality, especially the reality and probably the metal, right? But otherwise, if you see, reality is still bullish in the medium term. Crossover is just happening, but in spite of such 9.5% of fall, it still maintains the medium term bullishness. That was a kind of vertical up move that we are seeing in the reality sector. So as of now, some more of this correction could come in the auto, in the pharma, and probably in the reality also, because all of these three were heated up extremely high, and it may need some more cool off. But otherwise, FMCG and metal and IT index looks okay in the medium term as of now. Things may change. So moving ahead, if we try to understand the heavyweight stocks that contribute maximum to the indices, HDFC Bank has finally climbed back with the sideways from the bearish zones on the medium term, but the trend has not crossed over yet. The trend still remains negative on the ADX indicator, right, for the medium term charts. You clearly see in the last 3 weeks were fine green candles for the Nifty, but long way to go up. Reliance Industries had taken a deep cut, and wide range bearish candles is what I see, but momentum in the medium term is still lent despite this kind of fall. Still maintains the bullishness on the medium term, and the crossover to the bear zones has not capped. So medium term absolutely fine. ICICI Bank had not taken the cut last week. It was mostly consolidating with a small body, but the sell-off did come in there, but momentum is still bullish on the medium term. It was only the short term where it got slightly impacted, that's all. But so ICICI Bank, Reliance remains strong, and HDFC is catching up by climbing into the sideways zones, and Infosys IT sector did well. TCS also did well. Both were performing, and they're breaking out of that parallel channel and then slowly moving up, heading up towards. Kodak Bank, as usual, has been moving up and down, in the sideways zones. ITC also interestingly had found some support, and huge buying has come in following some corporate fundamental news of stock sell-off by some partner came in. So look at this volume, huge rise volume, which gives a possibility of this breakout of a flag, and probably 400 maybe a bottom, right, where buying has come in, and then it will move up now. So ITC doing good. IT stocks, Infi and the TCS is doing good, and ICICI Bank and Reliance okay, despite the fact that Reliance did got hit, and then last week HDFC Bank tried to move up. So overall, index heavyweight stocks are not doing bad, but across the sector sell-off has happened because mid-cap and small cap got corrected because of the SEBI directive. So that looks fine. Look at this, mid-cap and small cap indices. Sharp deep cut correction of 15 to 20% can clearly be seen. 20% probably on these small cap index, right? For five weeks of selling, and it's a sharp sell-off in the small cap index, and there is a possibility that it can find a support at this and then consolidate here and then slowly moves up. Momentum is still intact, bullish on the mid cap, but small cap, because of that sharp sell-off previous week, it has slipped sideways from. So trend has crossed over in the medium term to the bear zones on both the axes, right? So this is exactly what screwed up the market as last week. Heavyweights are doing good and doing okay despite the line sell-off, and across the sector there was a sell-off, and mid cap and small cap got hit. That's a summary of the different indices in the market. That's exactly what happened in the market. But institutional selling, look at this. Fyers did not sell that much. It was only 800 crores after all. But they sold, and they were heavily buying 14,000 crores last week. So it was a retail panic. That long reality section also on the 5 years moved down last week. But it was a Friday. The Fyers medium bearish on the futures and kind of the options, and the pro traders are also bearish on futures and options. So it's a retailers, so the mutual fund money is bullish on the indices, right? So that's what I know for the Fyers and the Fyers showing. And yeah, so it was Fyers were buyers last week, net to net, after a very long time, but it did not sustain. But this week they did not sell off much. In fact, most institutions have poured in more money. Right, that's what happened last week. Not bad. But if you look at the data, you can see that there was a 4,500 crores of sell-off that happened on Wednesday, and just 2 days before on Monday, similar 4,200 buying happened. That's the way FIs are playing. They come in buying 4,000 crores one day. After 2 days, they sell for those more than that. So that is still a worry. Why is it that they're not coming as buyers? Probably they're waiting for the interest rate cut news that will come in next week. Next week, that way it's going to be all volatile. But regardless of the fact, domestic institutions has been buying and buying forever, which is what is holding the market, mutual fund money. Moving ahead, if you look at the global markets, basically the US markets, US indices, and you would also look at the currencies and the global commodities. Dollar, if you see, dollar has moved up close green, 0.7% up, and it's at 103.4, and sideways. It was falling, it was in falling, now it's in sideways and rising up. USD INR currency pair has closed at 0.18%. It's 82.86, so it's kind of sideways and rising up. It is also being managed by the central banks at the 83 level, 83.5 levels since very long time, and you can see that in the charts here. Look at this. It's ages. It's been more than probably 15-20 weeks now, struggling to make. Neither is it falling down nor is it breaking out. It's been completely managed. That's what the the USD INR currency pair chart is showing. Dollar index, by the way, is not ready to fall down. It's consolidating at the neckline zone, so you can see. Crude oil is creating some threat. It's heading towards the top of the channel and above the 80 plus. It's a worry, and if it is breaking out of the channel, then we have problems. But it is not still climbed in the bull zone, so probably it may face some resistance at the zone, and then you can fall back probably. But you have to keep a watch out whenever it's spiking up and reaching the top of that breakout zone. Gold, interestingly, had made all-time high previous week with bullish momentum, and this week's small swell of profit booking has come in. A 1% cut has come in, but gold is at all-time highs. And is there a reason for people shifting the money to safer havens? Are they seeing the risk in the equity markets, risk of a correction? That's why you have to keep a watch on this hedging instrument of gold. So there is some need for close watch out on the crude oil and the gold, the global commodities. And also US markets are flattish spread, and that's flattish spread at the very top of a bull rally, at the very top all-time high levels with bullish momentum. So retracements could come in any time, or it could be a small consolidation and then for the moves. But there is a high probability that corrections will come in because US markets have been rallying a lot. But you cannot rule out what is the outcome of the of a dovish rate cut that can come in next week. So very crucial, critical week is coming ahead, where we have to keep a close watch on commodities as well as oil, as well as the US markets. The global cues could make a big shift next week. There's a high probability that it can make it may not be as calm as it used to be this week, previous week. Global markets, if you see, right, the Dow Jones is closed indecisive, flattish close. At the very top, the flag formation is happening. Momentum is bullish, absolutely. At the 70s of RSI trend is also bullish. Nasdaq is also all-time high, 2 weeks of correction, flat close. S&P 500 also flat close at the all-time high at the very top in the middle of a rally. Momentum bullish, trend bullish. A retracement of 5% could have an impact on our markets as well if it happens. Fortunately, it may be consolidating here for more time, and then eventually on the news of a positive dovish news from the Fed, it could break out. That also is possible. Keep a close watch there. Two stock mix, both on the short side. Dr. Lal path is a possibility of a breakdown from here. Have tight stop losses. If you lose, no problems. It had bounced multiple times from here, but if you get it, it can be really good risk reward. Reason for the trade is because the momentum of the medium term has dropped in the bear zones. Trend is crossed over just in the bear zones on the weekly charts, and then good risk reward trade could come and trail your stop losses, have tight stop losses, and then risk reward more, maybe 1:1, 2. After 1:1, 2 could come in if it breaks down that neckline. More could come here to train actually. If it really breaks down this neckline of this head and shoulder pattern, it could go as low as the height of the head, which is huge, 200 points or something. Even if that doesn't, that's why you want to trail if it breaks down, but that may be very volatile. It may not be an easy 2000. So keep a close watch. What is indicated on the charts may not always work out, but yeah, there is a probability. Volumes are also bearish, high red. We can see that above moving average. But India, there is a probability of this moving at least to the bottom of this trend line channel. It's a good risk reward trade. The reason for the trade is RSI below 40. Trend crossed over, bearishness is increasing. Volumes are also bearish red above moving average. So, Bata India and Dr. Lal Path clubs both short side trades. Another bear call calendar spread is what you're seeing. It's a calendar because you're selling, because you're buying the next week, next to next week's call at 22,600, and you're selling the upcoming week's call at 22,300. So you sell a lower call, a higher next to next week's call, and then a spread is formed, and the difference you gain. The squad is not that great, but don't need to wait for the last day. The good thing is that if it screws up and then market breaks out, the market falls, then you don't have anything much to lose. But if market stays there, or even if it tries to move up slightly, not beyond the 22,400, then again it's completely risk defined. Margin requirements are less, position size as per your capital, unless the big spikes to 20 kind of levels. You can increase the capital size. Right? Probability of trade is very good. Right? The range is also reasonable. Right? No loss on the downside. No loss on the downside. It's completely risk defined, one side safe trade. Weekly options Nifty. Let's just wrap it up. Market did fell off. It retraced 2.2 to 3.25% from the all-time highs on both indices, and it gave up the price gains, momentum gains, and trend gains on. It all in fact lost the 20 exponential moving average as well, but interestingly, higher low, high pattern is still intact, and total correction of 4.5 and 8.5 still remains as the last correction that has happened, on a 24 to 26% correction on the Nifty and the Banknifty. So it was a bull rally of cup and handle and flank breakouts that we were going through, and suddenly you have a correction that has come in, nearly 3%, right? So fingers crossed, and then see what happens. It's a support zone. In favor of bulls, one of the things in favor, the indices are still above the weekly exponential moving average in both indices, right? Medium terms fine, price action. Index is flattish. It has not spiked up as it was expected to do when the prices fall. And price is at a support levels with a change in polarity possibility. We already talked about that just now. Higher high, higher low pattern is still not negated on the short term. It's very close by at 21,800 in the case of Nifty. So Fyers did not sell big. Fyers did not sell big last week, and previous to previous week, they were buyers net after a very long time. So that gives a hope that institutions may come in to support, continue to support. Right? So a few factors in favor of the bulls, but most of the factors in favor of the bears. You have the across the sector momentum and the trend that's turning negative with 9% and 7% metal and reality, that kind of huge cuts that came in suddenly. Steep correction in the mid cap and the small cap. Short-term momentum has slipped back to sideways, and with bearish trend crossover that has happened, the band is absolutely sideways with bearish bias. Futures is long and winding and negative short build-up, and PCR is not bullish enough. US market is flat at the very top, anticipating some corrections that may come in. Crude oil is rising up, gold is spiking up. Right, W patterns getting negated, nullifying the breakout targets and all that. Trading exponential moving average losing. So all factors in favor of the bears. So market will do a correction mode from the all-time highs before even the Banknifty making an all-time high. It gave the price momentum and the trend change gains that happened previous week, and the question now is it some consolidation before it gains enough strength for the move up, or is it more deeper corrections after a very long rally? So technically charts are now consolidating, and so the market view is neutral with a bearish bias, of course. So the global views of inflation, interest rate, war, especially the interest rate news is coming out next week for the Fed. All these things could turn to cause bearish moves, which could be very sharp, and it will go to the extent of 10 to 15. It can be a black swan if it goes with 20% and more. So all these things can happen that can screw up all the technical analysis on a toss that could have come in anytime. So all that can be done is manage your risk and have a risk mitigation plans and portfolio level stop losses and exit plans and all that. That's all in our hands, so that we remain for another day in the market. Otherwise we get finished and kicked out of the market. So the 21,500 to 22,500 is the levels for the next week for the Nifty, and 45,500 to 48,000 is the levels for the Banknifty. So the key is to maintain the 22,000 and 47,000 on the indices. If that's not happening, until then it will be consolidating. And the scope for next leg of rally may be delayed, right? So as I always say, have hedges and use vertical splits in non-directional option strategies, because directional players not come in. Market is neither bearish nor bullish, it's sideways. Non-directional will talk, but option sellers, market is not much in favor of option sellers, considering the IVR, the realized RB spread difference. Although the percentile is high and then decay benefits could come in, IVR spread is saying that still it's not much in favor, but playing spreads in non-directional option strategies could still help, but not directional strategies yet. But if this market is turned completely bearish on both time frames, on both indices, then that's the time we have to go direction on the bear side. We have not reached that yet, at least on the indices. So protect your capital. Use these corrections as opportunities for long-term investments in small quantities in SIP mode, in quality stocks for the long term. And also you could protect your existing stocks by using option strategies like covered calls and covered puts to get rental incomes. Right, so check out the playlist for those videos on that. Right, play safe, and VIX is okay now, but if it spikes up, control the position size, and that's how we manage your risk. And look at the probabilities of resistance support. We already discussed a lot, and then go back and look at that, look at the charts, and then have a view. My view is what is put, it may not be your view. My view has been justified with all the facts that we had analyzed. Similarly, you can have your view with your justification. Still you can get screwed up if you're not managing the risk. Right, that's all I have. This is the channels where I'm active. Twitter, X channel, I have regular posts that comes in during the intraday. Check out that. Subscribe if you're not subscribed. Thanks for watching. Happy trading, happy learning. Bye bye.